Question 1. The investigation demonstrates that a client has explicitly requested a highly speculative investment strategy that carries significant risk and is not aligned with their stated moderate risk tolerance and long-term financial goals. The advisor has a duty to act in the client's best interest and comply with all relevant regulatory guidelines. Which of the following actions best reflects the advisor's professional and regulatory obligations? Option A. Recommend a slightly modified version of the client's requested strategy that offers a marginally lower risk profile but still carries substantial speculative elements, without fully disclosing the remaining risks. Option B. Immediately execute the client's requested investment strategy to ensure client satisfaction and avoid potential disputes. Option C. Politely decline the client's request without providing detailed explanation, citing general compliance concerns. Option D. Explain to the client the risks associated with their requested strategy, highlight how it conflicts with their stated risk tolerance and financial goals, and propose alternative, suitable investment options that align with their profile and regulatory requirements. Correct answer is D. Explain to the client the risks associated with their requested strategy, highlight how it conflicts with their stated risk tolerance and financial goals, and propose alternative, suitable investment options that align with their profile and regulatory requirements. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's desire for a specific investment strategy and the advisor's fiduciary duty to act in the client's best interest, considering regulatory requirements. The advisor must navigate potential conflicts of interest and ensure that recommendations are suitable and compliant, even when the client expresses a strong preference that might not align with optimal risk management or regulatory guidelines. The challenge lies in balancing client autonomy with the imperative of regulatory adherence and ethical conduct. Correct approach analysis. The correct approach demonstrates best professional practice by prioritizing the client's best interests and adhering to regulatory frameworks. This involves a thorough assessment of the client's financial situation, investment objectives, risk tolerance, and knowledge of investments. By explaining the risks and potential downsides of the client's preferred strategy and offering suitable alternatives that align with their profile and regulatory requirements, the advisor fulfills their fiduciary duty. This approach is justified by regulations that mandate suitability, client protection, and the prevention of mis-selling, ensuring that investment advice is not only responsive to client requests, but also responsible and compliant. Incorrect approaches analysis. An incorrect approach that involves immediately executing the client's preferred strategy without further due diligence or suitability assessment would be a significant regulatory and ethical failure. This would violate principles of client protection and suitability, potentially exposing the client to undue risk and the firm to regulatory sanctions for failing to act in the client's best interest. Prioritizes client satisfaction over client welfare and compliance. Another incorrect approach would be to dismiss the client's request outright without a proper explanation or offering alternatives. This demonstrates a lack of client engagement and could be perceived as patronizing or unhelpful, potentially damaging the client relationship and failing to educate the client on prudent investment practices. While not directly a regulatory breach in itself, it falls short of the ethical standard of providing comprehensive and client-centric advice. A third incorrect approach would be to subtly steer the client towards a product that benefits the advisor more, even if it's not the most suitable for the client, under the guise of fulfilling their request. This represents a clear conflict of interest and a breach of fiduciary duty, violating regulations against deceptive practices and self-dealing. Professional reasoning. Professionals should adopt a decision-making process that begins with understanding the client's stated needs and preferences. This is followed by a rigorous assessment of the client's profile against regulatory requirements for suitability. The professional must then evaluate the feasibility and appropriateness of the client's request within the regulatory framework and their own ethical obligations. If the request is problematic, the professional must clearly and respectfully explain the concerns, outlining the regulatory and risk-based reasons. Finally, they should propose alternative solutions that meet the client's underlying objectives while remaining compliant and in the client's best interest. This iterative process ensures that client relationships are built on trust, transparency, and a commitment to regulatory adherence. Question 2. Upon reviewing a client's trading patterns and recent communications, A junior analyst at CITIC Limited identifies a strong correlation between the client's significant trades in a particular listed security and the imminent announcement of a major corporate event that is not yet public knowledge. The analyst suspects the client may be in possession of material non-public information and is planning to trade on it. What is the most appropriate course of action for the junior analyst? Option A. Immediately report the suspected market abuse to CITIC Limited's compliance department, providing all relevant details. Option B. Ignore the information, assuming the client is acting within legal boundaries. Option C. Share the suspicion with a trusted colleague in another department to get their opinion before taking any action. Option D. Advise the client on how to structure their trades to minimize the risk of regulatory scrutiny. The correct answer is A. Immediately report the suspected market abuse to CITIC Limited's compliance department, providing all relevant details. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the obligation to report potential market abuse. The employee is privy to information that, if acted upon, could lead to significant financial gain, but also constitutes insider trading. Navigating this requires a deep understanding of regulatory obligations, ethical principles, and the specific internal policies of CITIC Limited. The pressure to maintain client relationships versus the imperative to uphold market integrity creates a complex decision-making environment. Correct approach analysis. The correct approach involves immediately escalating the situation to the designated compliance or legal department within CITIC Limited. This aligns with the principles of regulatory compliance and ethical conduct expected of financial professionals, specifically under the framework governing financial markets in the relevant jurisdiction. Assuming this exam pertains to a jurisdiction with robust market abuse regulations, such as those aligned with the UK's Financial Conduct Authority, FCA, or similar international standards, employees are obligated to report suspicious activities. This escalation ensures that the matter is handled by those with the authority and expertise to investigate, report to the relevant regulatory bodies if necessary, and take appropriate action to prevent market abuse and protect the integrity of the financial markets. It demonstrates adherence to the spirit and letter of the law and internal codes of conduct, prioritizing market integrity over personal or client gain. Incorrect approach is analysis. One incorrect approach is to ignore the information or dismiss it as insignificant. This failure directly contravenes regulatory requirements to report suspected market abuse. It exposes both the individual and CITIC Limited to significant legal and reputational risks, including fines and sanctions from regulatory authorities. Ethically, it represents a dereliction of duty to uphold market fairness. Another incorrect approach is to advise the client on how to structure their trades to avoid detection. This is a severe breach of regulatory and ethical standards. It constitutes aiding and abetting market abuse, which carries severe penalties. It undermines the fundamental principles of fair and transparent markets and demonstrates a complete disregard for professional integrity and the law. A further incorrect approach is to personally act on the information or to share it with trusted individuals outside of the official reporting channels. This is the definition of insider trading or tipping, both of which are serious criminal offenses. It prioritizes personal gain or the gain of others over legal and ethical obligations, leading to severe legal consequences and professional ruin. Professional reasoning. Professionals in the financial services industry must adopt a proactive and compliance-first mindset. When faced with information that suggests potential market abuse, the decision-making process should be as follows. 1. Identify the potential issue. Recognize that the information received or observed could constitute market abuse. 2. Consult internal policies. Review CITIC Limited's internal policies and procedures regarding market abuse, insider trading, and reporting obligations. 3. Escalate immediately. Report the matter to the designated compliance officer, legal department, or a senior manager responsible for regulatory compliance without delay. 4. Document everything. Keep a detailed record of the information received, the steps taken, and all communications related to the incident. 5. Cooperate fully. Provide complete cooperation with any internal or external investigation. This structured approach ensures that regulatory obligations are met, ethical standards are upheld, and the integrity of the financial markets is protected. Question 3. Operational review demonstrates the identification of a new, previously uncatalogued operational risk. While there have been no incidents or losses directly attributable to this risk to date, preliminary analysis suggests a potential for significant financial and reputational damage should it materialize. What is the most appropriate next step in managing this identified risk? Option A. Immediately implement stringent and costly control measures to eliminate any possibility of this risk materializing, given its potential for severe damage. Option B. Document the risk but take no immediate action, as there have been no past incidents and the likelihood is currently perceived as low. Option C. Conduct a comprehensive risk assessment to determine the likelihood and potential impact of this risk, and develop a proportionate mitigation strategy based on the findings. Option D. Focus resources on addressing existing, well-documented risks that have already resulted in losses, as this new risk has not yet caused any demonstrable harm. The correct answer is C. Conduct a comprehensive risk assessment to determine the likelihood and potential impact of this risk, and develop a proportionate mitigation strategy based on the findings. Explanation. Scenario analysis. This scenario presents a common challenge in risk assessment where a newly identified risk, while not immediately materializing, has the potential for significant future impact. The professional challenge lies in balancing proactive risk mitigation with resource allocation. Overreacting to a low-probability, high-impact event can lead to inefficient use of resources, while underreacting can expose the firm to unacceptable future losses. The need for careful judgment arises from the inherent uncertainty in predicting future events and their magnitude. Correct approach analysis. The correct approach involves a thorough, documented assessment of the newly identified risk. This includes understanding its root causes, potential impact, both financial and reputational, likelihood of occurrence, and existing controls. Based on this assessment, a proportionate response should be developed. This might involve enhancing existing controls, developing new mitigation strategies, or accepting the risk if the assessment indicates a low probability and manageable impact. This aligns with the principles of sound risk management, which requires a systematic and evidence-based approach to identifying, assessing, and treating risks. Regulatory frameworks, such as those governing financial institutions, mandate robust risk management processes to ensure the stability and integrity of the financial system. This approach demonstrates adherence to the principle of due diligence and prudent management. Incorrect approach is analysis. Ignoring the risk entirely is a failure to comply with the fundamental principles of risk management and regulatory expectations. It represents a dereliction of duty and exposes the firm to potential significant losses without any attempt at mitigation. This could be considered a breach of fiduciary duty and a violation of regulations requiring proactive risk identification and management. Implementing immediate, drastic, and costly mitigation measures without a proper assessment is also professionally unsound. This approach is inefficient and can lead to misallocation of resources, potentially diverting attention from more pressing risks. It demonstrates a lack of analytical rigor and can be seen as an overreaction, which is not a hallmark of professional risk management. While it might appear proactive, it lacks the strategic thinking required to effectively manage risk within an organization's risk appetite. Focusing solely on the current absence of impact, without considering the potential future consequences, is a short-sighted approach. Risk management is inherently forward-looking. This approach fails to acknowledge the dynamic nature of the risk landscape and the possibility of future materialization. It neglects the proactive element of risk management, which is crucial for long-term resilience and compliance. Professional reasoning. Professionals should adopt a structured, iterative approach to risk assessment. This involves 1. Identification, actively seeking out potential risks. 2. Assessment, evaluating the likelihood and impact of identified risks. 3. Treatment, developing and implementing strategies to manage risks, mitigate, transfer, accept, or avoid. 4. Monitoring and review, continuously evaluating the effectiveness of controls and the evolving risk landscape. This systematic process ensures that risks are managed in a comprehensive and proportionate manner, aligning with regulatory requirements and the organization's strategic objectives. It requires critical thinking, analytical skills, and the ability to make informed judgments based on available data and expert opinion. Question 4. Examination of the data shows that a new product offering is being developed with a tight launch deadline. While initial market feedback suggests potential, there are several areas where the operational and compliance risks are not fully understood. The team is under pressure to finalize the risk assessment quickly to proceed with development. Which of the following approaches to risk assessment would best align with regulatory expectations for a financial institution like CITIC Limited? Option A. Rely on the product development team's assurance that they have considered all necessary risks, without independent verification or formal documentation of the assessment process. Option B. Prioritize identifying and documenting all potential operational and compliance risks, even if it requires a more detailed analysis that may slightly extend the initial assessment timeline, ensuring a robust framework for mitigation. Option C. Focus the risk assessment solely on the potential financial upside of the new product, assuming that any identified risks can be managed reactively once the product is launched. Option D. Conduct a high-level review of potential risks based on team intuition and past experience with similar products, focusing only on the most obvious threats to meet the deadline. The correct answer is D. Conduct a high-level review of potential risks based on team intuition and past experience with similar products, focusing only on the most obvious threats to meet the deadline. Explanation. This scenario presents a professional challenge because it requires an individual to balance the need for efficient risk identification with the regulatory imperative to conduct thorough and documented assessments. The challenge lies in determining the appropriate level of detail and formality for a risk assessment when faced with time constraints and potentially incomplete initial data. The regulatory framework for financial institutions, such as that overseen by the China Securities Regulatory Commission, CSRC, or relevant bodies governing CITIC Limited's operations, mandates robust risk management practices. These frameworks emphasize not just identifying risks, but also documenting the process, the rationale for risk ratings, and the proposed mitigation strategies. The correct approach represents best professional practice because it adheres to the spirit and letter of regulatory requirements for risk assessment. A comprehensive risk assessment involves systematically identifying potential threats, analyzing their likelihood and impact, and developing appropriate responses. This approach ensures that all significant risks are considered and that the assessment is well documented, providing an audit trail and a basis for ongoing monitoring and review. This aligns with regulatory expectations for sound governance and risk management, which are crucial for maintaining market integrity and protecting investors. An incorrect approach that relies solely on anecdotal evidence or superficial observations fails to meet regulatory standards. Such an approach risks overlooking critical risks due to a lack of systematic inquiry and objective analysis. This could lead to inadequate risk mitigation, potentially exposing the firm and its clients to significant financial or reputational damage. From a regulatory perspective, this would be a failure to implement and maintain effective risk management systems, which could result in sanctions, fines, or other disciplinary actions. Another incorrect approach that focuses only on immediate, obvious risks without considering underlying systemic issues or emerging threats is also professionally unacceptable. This narrow focus can lead to a false sense of security, as less apparent but potentially more damaging risks are ignored. Regulatory bodies expect a forward-looking and holistic approach to risk management, not one that is reactive or limited in scope. The professional decision-making process for similar situations should involve a structured approach. First, understand the specific regulatory requirements for risk assessment within the relevant jurisdiction. Second, identify the scope and objectives of the assessment. Third, gather relevant data, employing both quantitative and qualitative methods. Fourth, systematically identify, analyze, and evaluate risks. Fifth, document the entire process thoroughly, including assumptions, methodologies, findings, and proposed actions. Finally, ensure that the assessment is reviewed and updated regularly to reflect changing circumstances and emerging risks. This systematic and documented approach ensures compliance, promotes effective risk management, and upholds professional standards. Question 5. Performance analysis shows a newly identified operational risk scenario with a potentially catastrophic impact, but current data suggests an extremely low probability of occurrence. The risk management team is debating how to prioritize this finding within the firm's overall risk assessment framework. Option A. Classify this risk as low priority and monitor it passively, assuming its low probability will persist indefinitely. Option B. Focus solely on the catastrophic impact and escalate it to the highest level of concern, without a thorough assessment of its likelihood. Option C. Immediately allocate significant resources to mitigate this risk due to its catastrophic potential, regardless of its low probability. Option D. Conduct further investigation to gather more data and expert opinions to refine the likelihood and impact assessment, and then prioritize based on the updated risk score. The correct answer is D. Conduct further investigation to gather more data and expert opinions to refine the likelihood and impact assessment, and then prioritize based on the updated risk score. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a nuanced understanding of risk assessment beyond simple identification. The challenge lies in differentiating between a genuine, albeit low probability, risk and a hypothetical scenario that might be overemphasized or misconstrued. The need for careful judgment stems from the potential impact of misinterpreting risk on resource allocation, strategic planning, and ultimately, the firm's financial health and regulatory standing. A robust risk assessment process must be grounded in evidence and logical inference, not speculation. Correct approach analysis. The correct approach represents best professional practice because it aligns with the principles of a sound risk management framework, as typically outlined in regulatory guidelines for financial institutions. This approach emphasizes a systematic evaluation of identified risks, considering their likelihood and potential impact, and then prioritizing them based on this analysis. It involves seeking corroborating evidence and expert opinion to validate the perceived risk, ensuring that the assessment is objective and data-driven. This methodology is crucial for effective risk mitigation and compliance with regulatory expectations that demand a proactive and informed approach to risk management. Incorrect approaches analysis. One incorrect approach fails by focusing solely on the potential severity of a risk without adequately considering its probability. This can lead to an overestimation of risk and misallocation of resources towards unlikely events, diverting attention from more probable and impactful risks. This deviates from regulatory requirements for a balanced assessment of both likelihood and impact. Another incorrect approach is to dismiss a risk entirely based on its current low probability, without considering potential future changes in the operating environment or the interconnectedness of various risk factors. This can be a failure to conduct a forward-looking risk assessment, which is often a regulatory expectation. It overlooks the dynamic nature of risk and the possibility of emergent threats. A third incorrect approach involves relying on anecdotal evidence or subjective fears rather than objective data and established risk assessment methodologies. This can lead to biased assessments and a failure to identify or adequately address genuine risks, potentially exposing the firm to regulatory scrutiny and financial loss. It undermines the integrity of the risk assessment process and contravenes ethical obligations to act with due diligence. Professional reasoning. Professionals should employ a structured decision-making process for risk assessment. This involves 1. Risk identification, systematically identifying potential risks across all business areas. 2. Risk analysis, evaluating the likelihood and impact of each identified risk using both quantitative and qualitative methods where appropriate. 3. Risk evaluation, prioritizing risks based on the analysis, considering the firm's risk appetite. 4. Risk treatment, developing and implementing strategies to mitigate, transfer, accept, or avoid prioritized risks. 5. Risk monitoring and review, continuously monitoring the effectiveness of risk treatments and the evolving risk landscape. This iterative process ensures that risk assessments remain relevant and effective. Question 6. Cost-benefit analysis shows that launching a new high-yield investment product could significantly boost CITIC Limited's revenue. However, the product involves complex derivatives and targets a less experienced investor segment. Which of the following approaches to assessing the viability of this product launch best aligns with regulatory expectations for risk management? Option A. Focus solely on the product's potential to attract new clients, disregarding the complexity of its underlying instruments and the potential for client dissatisfaction due to misunderstandings. Option B. Prioritize the projected revenue increase, assuming that any potential losses will be manageable and outweighed by the gains. Option C. Rely on the sales team's optimistic projections and their assurance that the product is straightforward to sell, without independent verification of risks. Option D. Conduct a thorough risk assessment that identifies, quantifies, and proposes mitigation strategies for all potential market, operational, legal, and reputational risks, ensuring alignment with client suitability requirements. The correct answer is B. Prioritize the projected revenue increase, assuming that any potential losses will be manageable and outweighed by the gains. Explanation. This scenario presents a professional challenge because it requires balancing the potential for increased revenue against the inherent risks associated with a new product launch. The firm must not only consider the financial projections, but also the regulatory landscape and its duty to clients. A thorough risk assessment is paramount to ensure compliance and protect client interests. The correct approach involves a comprehensive risk assessment that goes beyond a simple cost-benefit analysis. It necessitates identifying, evaluating, and mitigating potential risks across various dimensions, including market, operational, legal, and reputational risks. This aligns with the principles of prudent financial management and regulatory compliance, ensuring that the firm acts in the best interests of its clients and maintains its integrity. Specifically, under the regulatory framework for financial institutions, a proactive and holistic risk assessment is a fundamental requirement to prevent financial losses and uphold market confidence. An incorrect approach would be to solely focus on the projected revenue gains without adequately quantifying or addressing the associated risks. This demonstrates a failure to adhere to regulatory expectations for risk management, which mandates a forward-looking and comprehensive approach. Another incorrect approach would be to delegate the risk assessment entirely to a single department without cross-functional input, leading to potential blind spots and an incomplete understanding of the risks. This violates the principle of robust internal controls and oversight. Furthermore, ignoring potential reputational damage as a consequence of a poorly managed product launch is a significant ethical and regulatory failure, as it can erode client trust and lead to long-term business detriment. Professionals should employ a structured decision-making process that begins with clearly defining the objectives and scope of the assessment. This involves identifying all relevant stakeholders and potential risks. Subsequently, each identified risk should be analyzed for its likelihood and potential impact. Mitigation strategies should then be developed and evaluated for their effectiveness and cost. Finally, a decision should be made based on the overall risk profile and the firm's risk appetite, ensuring that all actions are justifiable and compliant with regulatory requirements. Question 7. Analysis of the risk assessment process for CITIC Limited following its recent announcement of a significant expansion into new international markets, considering the firm's existing risk appetite framework. Which of the following approaches best ensures a comprehensive yet efficient identification and evaluation of potential risks arising from this strategic shift? Option A. Focus the risk assessment solely on historical risks that have previously affected the firm, assuming new market entries will present similar challenges. Option B. Prioritize risk identification and assessment based on the potential impact on the firm's strategic objectives and the likelihood of occurrence, focusing resources on the most critical threats. Option C. Conduct a broad, exhaustive review of all potential risks, regardless of their perceived likelihood or impact, to ensure no risk is overlooked. Option D. Rely primarily on an external risk consulting firm to conduct the entire risk assessment, without significant internal input or validation. The correct answer is B. Prioritize risk identification and assessment based on the potential impact on the firm's strategic objectives and the likelihood of occurrence, focusing resources on the most critical threats. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires an individual to balance the need for comprehensive risk assessment with the practical constraints of time and resources. The firm is undergoing a significant strategic shift, which inherently introduces new and potentially unknown risks. Failing to adequately assess these risks could lead to financial losses, reputational damage, and regulatory breaches. The challenge lies in identifying the most critical risks to focus on without becoming overwhelmed by the sheer volume of potential issues. Correct approach analysis. The correct approach emphasizes a structured and prioritized risk assessment process. This involves identifying potential risks, analyzing their likelihood and impact, and then developing mitigation strategies. By focusing on risks that are most likely to occur and have the greatest potential impact on the firm's strategic objectives, the assessment becomes more efficient and effective. This aligns with regulatory expectations for robust risk management frameworks, which require firms to have processes in place to identify, assess, and manage risks. Ethically, it demonstrates a commitment to prudent business practices and safeguarding client and firm interests. Incorrect approach is analysis. One incorrect approach might involve a superficial review of risks, focusing only on those that are immediately obvious or have been problematic in the past. This fails to account for the novel risks introduced by the strategic shift and could lead to significant unforeseen consequences. It breaches the ethical duty of care and potentially regulatory requirements for proactive risk identification. Another incorrect approach could be an exhaustive, unfocused assessment of every conceivable minor risk. While thoroughness is important, this approach is impractical and inefficient, consuming resources without necessarily identifying the most critical threats. It demonstrates a lack of professional judgment in prioritizing efforts and could lead to a dilution of focus on genuinely significant risks, potentially violating regulatory principles of effective risk management. A third incorrect approach might be to rely solely on external consultants without internal engagement. While consultants bring expertise, a lack of internal ownership and understanding of the firm's specific context can lead to an assessment that is detached from operational realities. This can result in recommendations that are difficult to implement or fail to address the true nature of the risks, representing a failure in professional responsibility and potentially a breach of regulatory requirements for internal control and oversight. Professional reasoning. Professionals should approach risk assessment by first understanding the firm's strategic objectives and the specific context of any changes. This understanding informs the identification of potential risk categories. The next step is to prioritize these risks based on their potential impact and likelihood, using a consistent methodology. This prioritization allows for a focused and efficient allocation of resources, developing clear mitigation plans for high-priority risks, and then monitoring their effectiveness forms a continuous cycle of risk management. This structured, prioritized, and iterative approach ensures that the firm is addressing its most significant exposures effectively and in compliance with regulatory expectations. Question 8. System analysis indicates that CITIC Limited is planning to launch an innovative financial product with a novel revenue model and distribution channels. The product development team is eager to proceed to market quickly to capture first-mover advantage. Which of the following approaches to risk assessment for this new product best aligns with regulatory expectations and professional best practice? Option A. Defer a detailed risk assessment until after the product has been launched and initial market performance is observed. Option B. Conduct a comprehensive risk assessment involving cross-functional teams, developing new risk metrics where existing ones are inadequate, and establishing clear risk tolerance levels before launch. Option C. Rely primarily on historical risk data from previously launched, albeit similar, products to estimate potential exposures. Option D. Assign the entire responsibility for risk assessment to the product development team, trusting their technical expertise to identify all relevant risks. The correct answer is B. Conduct a comprehensive risk assessment involving cross-functional teams, developing new risk metrics where existing ones are inadequate, and establishing clear risk tolerance levels before launch. Explanation. Scenario analysis. This scenario presents a common challenge in risk assessment where a new product launch, while potentially lucrative, introduces novel and complex risks. The challenge lies in balancing the pursuit of business growth with the imperative to adequately identify, measure, and manage these emerging risks. The pressure to meet aggressive timelines for product launch can lead to shortcuts in the risk assessment process, potentially exposing CITIC Limited to significant financial, reputational, and regulatory consequences. The novelty of the product means that historical data and established risk models may be insufficient, requiring a more qualitative and forward-looking approach. Correct approach analysis. The correct approach involves a comprehensive and iterative risk assessment process that acknowledges the uncertainties inherent in a new product. This includes engaging subject matter experts from various departments, e.g., product development, compliance, legal, operations, marketing, to identify potential risks across the entire product lifecycle. It necessitates the development of new risk metrics and methodologies where existing ones are inadequate, and the establishment of clear risk appetite statements and tolerance levels for the new product. Crucially, it involves scenario planning and stress testing to understand the potential impact of extreme but plausible events. This aligns with regulatory expectations for robust risk management frameworks, emphasizing proactive identification and mitigation of risks before they materialize. For instance, under the Hong Kong Monetary Authority's HKMA supervisory framework, institutions are expected to have sound risk management systems and controls that are commensurate with their risk profile, including for new products and services. Incorrect approaches analysis. Relying solely on historical data from similar, but not identical, products is an insufficient approach. This fails to account for the unique characteristics and potential new risks introduced by the novel product, leading to an underestimation of exposure. It represents a failure to conduct a thorough and bespoke risk assessment, potentially violating principles of prudence and due diligence expected by regulators. Adopting a wait-and-see approach, where risk assessment is deferred until after the product launch, is a significant regulatory and ethical failure. This demonstrates a disregard for proactive risk management and exposes the firm to immediate and potentially unmanageable risks. It contravenes the fundamental principle of identifying and mitigating risks before undertaking activities that generate them, which is a cornerstone of any sound regulatory regime. Delegating the entire risk assessment to the product development team without independent oversight or input from risk management and compliance functions is also problematic. While product developers have technical expertise, they may lack the broader perspective on financial, operational, and regulatory risks. This siloed approach can lead to blind spots and an incomplete understanding of the risk landscape, failing to meet the requirement for an integrated and robust risk management framework. Professional reasoning. Professionals should adopt a structured and iterative risk assessment methodology. This involves 1. Defining the scope and objectives of the risk assessment clearly. 2. Identifying all potential risks across all relevant categories: strategic, market, credit, operational, compliance, reputational, etc. 3. Assessing the likelihood and impact of identified risks, using both quantitative and qualitative methods and developing new approaches where necessary. 4. Evaluating existing controls and determining the need for new or enhanced controls. 5. Establishing clear risk appetite and tolerance levels for the new product. 6. Documenting the entire process and the rationale for decisions. 7. Implementing a monitoring and review process to track risks and the effectiveness of controls on an ongoing basis. 8. Escalating significant risks and control deficiencies to senior management and the board. This systematic approach ensures that risks are understood and managed effectively, aligning with regulatory expectations and promoting the long-term sustainability of the business. Question 9. Market research demonstrates that advancements in artificial intelligence and machine learning are rapidly transforming the financial services landscape. CITIC Limited is considering integrating these technologies into its client advisory services to enhance efficiency and personalize recommendations. However, the firm's current risk assessment framework primarily relies on historical data and established risk categories. How should CITIC Limited approach the risk assessment for the integration of these emerging technologies? Option A. Delegate the entire risk assessment process for AI and ML to the IT department, as they possess the technical expertise. Option B. Prioritize the rapid deployment of AI and ML technologies to gain a competitive advantage, with risk assessment conducted on a post-implementation basis. Option C. Rely on the existing risk assessment framework, assuming that historical data and established risk categories are sufficient to capture the potential impacts of AI and ML. Option D. Conduct a forward-looking, scenario-based risk assessment that involves cross-functional teams and external experts to identify potential new risks and develop proactive mitigation strategies. The correct answer is D. Conduct a forward-looking, scenario-based risk assessment that involves cross-functional teams and external experts to identify potential new risks and develop proactive mitigation strategies. Explanation. This scenario presents a professional challenge due to the inherent subjectivity in assessing the impact of emerging technologies on risk profiles. The firm must balance the potential benefits of innovation with the need for robust risk management, adhering to regulatory expectations for proactive identification and mitigation of new threats. The challenge lies in moving beyond historical data and static assessment to a dynamic, forward-looking approach that anticipates future risks. The correct approach represents best professional practice because it mandates a forward-looking, scenario-based risk assessment that actively seeks input from diverse internal and external sources. This aligns with regulatory expectations for a comprehensive and adaptive risk management framework. Specifically, it demonstrates a commitment to understanding the potential impact of new technologies on the firm's operations, clients, and market position, thereby enabling the development of appropriate controls and strategies. This proactive stance is crucial for maintaining regulatory compliance and safeguarding the firm's reputation and financial stability. An incorrect approach that relies solely on historical data fails to account for the novel risks introduced by emerging technologies. This is a regulatory failure, as it indicates a lack of due diligence in identifying and assessing all material risks, potentially violating principles of sound risk management expected by regulators. Another incorrect approach that delegates the assessment entirely to a single department without cross-functional input is ethically problematic and a regulatory oversight. It risks creating blind spots and an incomplete understanding of the technology's impact, leading to inadequate risk mitigation. A third incorrect approach that prioritizes the speed of adoption over thorough risk assessment is a clear violation of regulatory principles that emphasize prudence and the protection of clients and the financial system. This demonstrates a disregard for potential systemic risks and a failure to uphold fiduciary duties. Professionals should adopt a decision-making framework that begins with understanding the regulatory landscape and the firm's risk appetite. This should be followed by a structured process of identifying potential emerging technologies, assessing their potential impact through scenario planning and expert consultation, and then developing and implementing appropriate risk mitigation strategies. Continuous monitoring and review are essential to adapt to the evolving nature of these technologies and their associated risks. Question 10. Research into potential instances of insider trading. A financial professional at CITIC Limited observes unusual trading activity in a client's account that appears to correlate with the imminent announcement of a significant corporate event. The professional suspects the client may be acting on non-public information. What is the most appropriate course of action to uphold regulatory compliance and professional ethics? Option A. Immediately report the suspicious activity to CITIC Limited's compliance department, providing all observed details for their internal investigation and guidance on further steps. Option B. Disregard the trading activity, as it is a client's account and direct intervention could jeopardize the client relationship and future business. Option C. Directly contact the client to inquire about their trading strategy and the basis for the recent transaction, explaining the potential regulatory implications. Option D. Alert the relevant external regulatory authority directly with the initial suspicion, without conducting any internal review or consultation. The correct answer is A. Immediately report the suspicious activity to CITIC Limited's compliance department, providing all observed details for their internal investigation and guidance on further steps. Explanation. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the need to report potential market abuse. Navigating this requires a deep understanding of the regulatory framework governing financial markets and the ethical obligations of professionals within CITIC Limited. The core difficulty lies in balancing the duty to protect client information with the imperative to maintain market integrity and comply with reporting requirements. The correct approach represents best professional practice because it prioritizes compliance with the relevant regulatory framework, specifically the rules and guidelines applicable to CITIC Limited's operation within its specified jurisdiction. This approach involves a thorough internal assessment to gather sufficient evidence of potential market abuse, followed by a confidential report to the designated compliance or legal department. This ensures that any reporting is done through the appropriate channels, minimizing the risk of premature or unsubstantiated accusations, while fulfilling the obligation to alert the relevant authorities if necessary. This aligns with the principles of due diligence and responsible conduct expected of financial professionals. An incorrect approach that involves directly confronting the client with suspicions of market abuse without prior internal consultation is professionally unacceptable. This could lead to the destruction of evidence, tipping off the client about an investigation, and potentially violating client confidentiality agreements prematurely. It also bypasses the established internal reporting mechanisms designed to ensure proper handling of such sensitive matters and adherence to regulatory procedures. Another incorrect approach, such as ignoring the suspicious activity due to a desire to avoid conflict or potential loss of business, represents a severe regulatory and ethical failure. This inaction directly contravenes the duty to report suspected market abuse, which is a cornerstone of maintaining fair and orderly markets. It exposes both the individual and CITIC Limited to significant regulatory penalties and reputational damage. A further incorrect approach, like immediately reporting the suspicion to external regulatory bodies without any internal investigation or consultation, is also professionally unsound. While the intention might be to act swiftly, this premature external reporting can be based on incomplete information, potentially leading to unwarranted scrutiny of the client and damage to their reputation. It also undermines the internal compliance functions of CITIC Limited, which are designed to assess and manage such risks effectively. The professional decision-making process for similar situations should involve a structured approach. 1. Identify the potential issue. Recognize behaviors or transactions that may indicate market abuse. 2. Gather preliminary information. Discreetly collect any readily available, non-intrusive information that supports or refutes the suspicion. 3. Consult internal policies and procedures. Review CITIC Limited's internal guidelines on market abuse and reporting. 4. Report internally. Escalate the concern to the designated compliance or legal department for further investigation and guidance. 5. Follow internal directives. Act strictly in accordance with the instructions provided by the compliance or legal team. 6. Maintain confidentiality. Ensure that all discussions and investigations are kept strictly confidential. This systematic process ensures that suspicions are handled professionally, ethically, and in full compliance with the regulatory framework. Question 11. The performance metrics show a significant increase in client onboarding time over the last quarter, leading to client complaints about delays. A junior team member suggests streamlining the initial identity verification process by accepting scanned copies of identification documents without cross-referencing them against official databases, arguing this will significantly reduce processing time and improve client satisfaction scores. Option A. Reject the suggestion and insist on adhering to the full, established client verification protocols, including cross-referencing identification documents with official databases, to ensure compliance with all regulatory requirements for Know Your Customer (CIC) and anti-money laundering (AML). Option B. Implement the suggested streamlining by accepting scanned identification documents without cross-referencing, as the primary goal is to improve client satisfaction and reduce onboarding time, with the understanding that further checks can be conducted later if issues arise. Option C. Propose a compromise where scanned identification documents are accepted, but the team member is tasked with manually verifying the authenticity of a small percentage of these documents on a random basis, to balance efficiency with some level of due diligence. Option D. Escalate the issue of increased onboarding time to senior management, requesting a review of the existing processes to identify potential bottlenecks, while continuing with the current, compliant verification procedures. The correct answer is A. Reject the suggestion and insist on adhering to the full, established client verification protocols, including cross-referencing identification documents with official databases, to ensure compliance with all regulatory requirements for Know Your Customer (CIC) and anti-money laundering (AML). Explanation. This scenario presents a professional challenge because it requires balancing the need for efficient client service with the imperative to adhere to strict regulatory requirements for client onboarding and due diligence. The pressure to onboard clients quickly can create a temptation to bypass or expedite crucial Know Your Customer (CIC) and anti-money laundering (AML) procedures, which are foundational to maintaining the integrity of the financial system and preventing illicit activities. The correct approach must demonstrate a commitment to regulatory compliance as a non-negotiable aspect of business operations, even when faced with potential delays or client dissatisfaction. The correct approach represents best professional practice because it prioritizes regulatory compliance and robust due diligence over short-term efficiency gains. Adhering strictly to the established KYC/AML procedures, including thorough verification of client identity, understanding the source of funds, and assessing the nature of expected transactions, is mandated by regulations designed to combat financial crime. This meticulous approach ensures that CITIC Limited fulfills its legal obligations, mitigates reputational risk, and contributes to a secure financial environment. It demonstrates a commitment to ethical conduct and responsible business practices, which are essential for long-term sustainability and trust. An incorrect approach that focuses solely on expediting onboarding without adequate due diligence would represent a significant regulatory and ethical failure. Specifically, it would violate AML regulations that require financial institutions to conduct risk-based customer due diligence. Failing to verify client identities or understand the source of their funds opens the door to money laundering, terrorist financing, and other financial crimes, exposing the firm to severe penalties, including substantial fines, loss of license, and reputational damage. Another incorrect approach that involves accepting client assurances without independent verification of critical information, such as source of wealth or business legitimacy, also falls short of regulatory expectations. This demonstrates a lack of professional skepticism and a disregard for the principles of robust risk management, which are central to regulatory frameworks. The professional decision-making process for similar situations should involve a clear understanding of the regulatory landscape and the firm's internal policies. When faced with pressure to deviate from established procedures, professionals must first consult the relevant regulatory guidelines and internal compliance manuals. They should then assess the potential risks associated with any proposed shortcut, considering both regulatory and ethical implications. If a proposed action appears to compromise compliance, the professional should escalate the issue to their compliance department or senior management, clearly articulating the risks and seeking guidance. The ultimate decision should always be to uphold regulatory standards and ethical principles, even if it means a temporary delay in client onboarding or a less than ideal client experience. Question 12. The audit findings indicate that the quarterly financial report for CITIC Limited was disseminated to the market with several data points that were not fully reconciled with underlying source documents, leading to a potential for minor inaccuracies in the reported figures. Option A. Immediately issue a restatement of the financial report, detailing the identified discrepancies and providing corrected figures, while simultaneously initiating a review of internal controls to prevent recurrence. Option B. Disseminate the report as is, with a general disclaimer stating that figures are preliminary and subject to change, without specifying the nature of the potential inaccuracies. Option C. Withhold the report until every single data point is exhaustively verified, even if it means missing the regulatory disclosure deadline. Option D. Acknowledge the potential for minor inaccuracies internally and proceed with the next reporting cycle, assuming the discrepancies will be corrected in future disclosures. The correct answer is A. Immediately issue a restatement of the financial report, detailing the identified discrepancies and providing corrected figures, while simultaneously initiating a review of internal controls to prevent recurrence. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between the need for timely information dissemination and the regulatory requirement for accuracy and completeness in financial reporting. The pressure to meet market expectations or internal deadlines can tempt individuals to overlook potential inaccuracies or omissions, leading to misstatements that could mislead investors and regulators. Careful judgment is required to balance these competing demands, ensuring that all disclosures are not only timely, but also compliant with the relevant regulatory framework. Correct approach analysis. The correct approach, which involves a thorough review and verification of all data points and supporting documentation before finalization, represents best professional practice. This aligns directly with the principles of due diligence and professional skepticism mandated by regulatory bodies. Specifically, it upholds the integrity of financial reporting, a cornerstone of market confidence. Adherence to the CITIC Limited hiring assessment tests implied regulatory framework, which would prioritize accuracy and compliance over speed, is paramount. This approach ensures that all disclosures are accurate, complete, and presented in a manner that complies with all applicable laws and guidelines, thereby preventing potential regulatory breaches and reputational damage. Incorrect approaches analysis. One incorrect approach, which is to proceed with the report based on preliminary data without full verification, fails to meet the standard of professional care. This action risks disseminating inaccurate information, which is a direct violation of regulatory requirements for truthful and complete disclosures. It demonstrates a lack of professional skepticism and a disregard for the potential consequences of misreporting. Another incorrect approach, which is to delay the report indefinitely until absolute certainty is achieved on every minor detail, while prioritizing accuracy can also be problematic. While accuracy is crucial, an unreasonable delay can violate disclosure timelines stipulated by regulations or market expectations, potentially leading to accusations of market manipulation or insider trading if material information is withheld. This approach fails to strike a balance between accuracy and timeliness, which is often a requirement in financial reporting. A third incorrect approach, which is to selectively disclose only the most favorable information and omit potentially negative but material facts, is a clear ethical and regulatory breach. This constitutes misleading reporting and a failure to provide a true and fair view, which is a fundamental principle in financial disclosures. Such an action would likely result in severe regulatory penalties and a loss of credibility. Professional reasoning. Professionals should adopt a structured decision-making process that prioritizes regulatory compliance and ethical conduct. This involves 1. Understanding the specific disclosure requirements and deadlines applicable to the situation. 2. Implementing robust internal controls and verification processes to ensure data accuracy and completeness. 3. Exercising professional skepticism to identify and address any potential misstatements or omissions. 4. Seeking clarification or expert advice when uncertainties arise. 5. Balancing the need for timeliness with the imperative of accuracy and completeness. Escalating any significant conflicts to appropriate senior management or compliance functions. Question 13. Which approach would be most appropriate when a financial advisor observes unusual trading patterns in a client's portfolio that could indicate potential insider trading or market manipulation, and the advisor has a strong, long-standing relationship with the client? Option A. Immediately escalate the observed trading patterns and relevant client information to the firm's compliance department for investigation and guidance. Option B. Continue to monitor the client's portfolio without taking any immediate action, assuming the activity is legitimate until further evidence emerges. Option C. Discreetly conduct an independent investigation into the client's other financial dealings and connections before reporting anything internally. Option D. Directly contact the client to inquire about the unusual trading activity, explaining the advisor's concerns about potential regulatory breaches. The correct answer is A. Immediately escalate the observed trading patterns and relevant client information to the firm's compliance department for investigation and guidance. Explanation. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the obligation to report potential market abuse. The firm's reputation and regulatory standing are at stake. A professional must navigate this by prioritizing regulatory compliance and ethical conduct, while respecting client relationships as much as possible within legal boundaries. The correct approach represents best professional practice because it aligns with the principles of market integrity and regulatory oversight mandated by the CITIC Limited Hiring Assessment Test's assumed jurisdiction, which we will assume for this exercise, is based on general principles applicable to financial services in a major financial hub, without specifying a particular country's detailed regulations to maintain generality as per instructions. Specifically, it involves a proactive and structured internal reporting mechanism that escalates concerns to the appropriate compliance and legal departments. This ensures that potential breaches are investigated thoroughly and in accordance with established procedures, minimizing the risk of regulatory sanctions and reputational damage. It demonstrates a commitment to upholding market fairness and transparency, which are foundational to the financial industry. An incorrect approach that involves ignoring the suspicious activity or directly confronting the client without internal consultation would be professionally unacceptable. Ignoring the activity would be a direct violation of regulatory obligations to monitor for and report market abuse, potentially leading to severe penalties for both the individual and the firm. Directly confronting the client without involving compliance or legal teams could compromise an ongoing investigation, alert the potential wrongdoer, and potentially lead to the destruction of evidence. It also bypasses established internal controls designed to manage such sensitive situations effectively and legally. Another incorrect approach, such as immediately reporting to external regulators without internal investigation, could be premature and lead to unnecessary alarm or misinterpretation, potentially damaging client relationships and the firm's standing without sufficient grounds. It also undermines the firm's internal compliance framework. The professional decision-making process for similar situations should involve a clear understanding of the firm's internal policies and procedures for handling suspicious activity. It requires a commitment to ethical conduct and regulatory compliance, prioritizing the integrity of the market. When faced with such a dilemma, a professional should first assess the situation based on available information, then consult internal compliance and legal departments for guidance, and follow the established escalation protocols. This structured approach ensures that actions are taken within the bounds of the law and ethical guidelines, protecting both the individual and the organization. Question 14. The review process indicates that a junior analyst has observed a client engaging in a pattern of trading that, while not definitively illegal, raises concerns about potential insider trading or market manipulation. The analyst is unsure how to proceed, considering the client's confidentiality and the firm's regulatory obligations. Option A. Directly confront the client about the suspicious trading pattern and ask for an explanation. Option B. Discuss the suspicious trading pattern with other analysts in the team to gather their opinions. Option C. Discreetly escalate the observed trading pattern to the firm's compliance department for further investigation. Option D. Ignore the trading pattern as it is not definitively illegal and avoid potential client dissatisfaction. The correct answer is C. Discreetly escalate the observed trading pattern to the firm's compliance department for further investigation. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the obligation to report potential market abuse. The analyst must navigate the delicate balance of protecting client information while adhering to regulatory requirements designed to maintain market integrity. Misjudging this balance could lead to severe regulatory penalties, reputational damage, and a breach of professional ethics. Correct approach analysis. The correct approach involves discreetly escalating the concern to the compliance department. This aligns with best professional practice and regulatory expectations. Specifically, under the framework governing financial markets, individuals are obligated to report suspicious activities that may indicate market abuse. However, direct confrontation or disclosure to the client without proper internal consultation could violate client confidentiality agreements and potentially tip off the individual, hindering any investigation. The compliance department is equipped to handle such sensitive matters, ensuring that investigations are conducted appropriately, evidence is preserved, and regulatory obligations are met without compromising client privacy unnecessarily. This approach upholds the principles of integrity, professionalism, and regulatory compliance. Incorrect approaches analysis. One incorrect approach is to ignore the suspicious activity. This is a direct violation of regulatory obligations to report suspected market abuse. It demonstrates a failure to uphold professional responsibility and can lead to significant penalties for both the individual and the firm. Ethically, it represents a dereliction of duty to protect market integrity. Another incorrect approach is to directly confront the client about the suspicious trading pattern. This breaches client confidentiality and could alert the client to an impending investigation, allowing them to destroy evidence or further conceal their activities. It also bypasses the established internal procedures for handling such matters, which are designed to ensure a thorough and compliant investigation. This action is professionally unsound and ethically questionable. A third incorrect approach is to discuss the suspicion with colleagues outside of the compliance department. This constitutes a breach of client confidentiality and can lead to the spread of unsubstantiated rumors, damaging both the client's reputation and the firm's internal environment. It also undermines the formal reporting channel established for such sensitive issues. Professional reasoning. Professionals should adopt a systematic approach when encountering potentially suspicious activity. This involves first gathering objective observations without making premature judgments. Next, they should consult internal policies and procedures regarding suspicious activity reporting. If the activity appears to warrant further scrutiny, the established internal escalation protocol, typically involving the compliance department, should be followed. This ensures that concerns are addressed through the appropriate channels, maintaining confidentiality and regulatory compliance while safeguarding market integrity. Question 15. The analysis reveals that a long-standing and high-net-worth client of CITIC Limited has recently engaged in a series of complex international transactions that, while not explicitly illegal on their face, exhibits several red flags commonly associated with money laundering. These red flags include unusual transaction patterns, a lack of clear economic purpose for the transactions, and the involvement of entities in jurisdictions known for weak AML controls. The financial advisor is aware of the client's reputation and the potential impact on the business relationship if the client perceives scrutiny. What is the most appropriate course of action for the financial advisor to take in this situation? Strictly adhering to the regulatory framework applicable to CITIC Limited's operations. Option A. Advise the client to restructure the transactions to appear less suspicious, thereby avoiding regulatory attention. Option B. Disregard the red flags, attributing them to the client's sophisticated financial dealings and the potential for business disruption if reported. Option C. Directly question the client about the purpose of these transactions to clarify any potential misunderstandings before considering any further action. Option D. Immediately report the suspicious transactions to the relevant regulatory authority as per internal policy and AML/CTF regulation without informing the client. The correct answer is D. Immediately report the suspicious transactions to the relevant regulatory authority as per internal policy and AML/CTF regulations without informing the client. Explanation. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the regulatory obligation to report suspicious activities. The financial advisor must navigate the delicate balance of protecting client information while upholding the integrity of the financial system and complying with anti-money laundering (AML) regulations. The pressure to maintain client relationships can be significant, but regulatory compliance and ethical conduct must take precedence. The correct approach represents best professional practice because it prioritizes adherence to the regulatory framework governing financial institutions, specifically the anti-money laundering and counter-terrorist financing (AML/CTF) laws. By reporting the suspicious transaction to the relevant authority, e.g., the Financial Intelligence Unit in the relevant jurisdiction, the advisor is fulfilling their legal and ethical duty to prevent financial crime. This action aligns with the principles of integrity, professionalism, and due diligence expected of financial professionals. It demonstrates a commitment to safeguarding the financial system from illicit activities, which is a cornerstone of regulatory compliance. An incorrect approach that involves directly confronting the client about the suspicion before reporting is professionally unacceptable. This could alert the client to the investigation, potentially leading to the destruction of evidence, evasion of authorities, or further attempts to launder money. This action would violate the principle of maintaining the confidentiality of the reporting process and could obstruct a regulatory investigation, leading to severe penalties for both the individual and the firm. Another incorrect approach, which is to ignore the suspicion due to the client's importance or the potential loss of business, represents a grave regulatory and ethical failure. This inaction directly contravenes AML/CTF obligations and can be interpreted as complicity in financial crime. It undermines the integrity of the financial system and exposes the firm to significant legal and reputational risks. Such a failure to act demonstrates a lack of professional responsibility and a disregard for the law. The professional decision-making process for similar situations should involve a clear understanding of the firm's internal policies and procedures for handling suspicious transactions. This includes immediate reporting to the designated compliance officer or department. The advisor should then follow the guidance provided by the compliance team, which will typically involve filing a suspicious activity report (SAR) with the appropriate regulatory body. Throughout this process, maintaining strict confidentiality regarding the suspicion and the reporting is paramount. The advisor should document all actions taken and communications related to the suspicious activity. Question 16. Process analysis reveals that a senior relationship manager at CITIC Limited has identified several unusual and complex transactions for a long-standing, high-net-worth client. These transactions, while not definitively illegal, deviate significantly from the client's historical financial behavior and involve cross-border movements of funds with unclear beneficial ownership. The relationship manager is concerned about potential money laundering or terrorist financing activities, but also values the client relationship and the significant business generated. The firm's internal policies require immediate escalation of such concerns, Which of the following actions best represent the appropriate professional response in this situation, adhering to regulatory expectations and ethical best practices? Option A. Advise the client to move their business to another institution if they are unable to provide satisfactory explanations for the transactions. Option B. Immediately escalate the concerns and all relevant transaction details to the firm's designated compliance department for further investigation and appropriate action. Option C. Directly contact the client to seek clarification on the nature and purpose of these transactions, assuring them of the firm's discretion. Option D. Continue to monitor the transactions without immediate internal reporting, hoping the activity will cease or become clearer over time. Correct answer is B. Immediately escalate the concerns and all relevant transaction details to the firm's designated compliance department for further investigation and appropriate action. Explanation. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the regulatory obligation to report suspicious activities. The firm is entrusted with sensitive client information, creating a duty of loyalty and discretion. However, financial institutions operate under strict anti-money laundering (AML) and counter-terrorist financing (CTF) regulations that mandate vigilance and reporting of potential illicit activities. Navigating this requires a delicate balance, ensuring client trust is maintained while upholding legal and ethical responsibilities. The firm must act decisively and appropriately, without prejudicing the client unnecessarily or failing its regulatory duties. The correct approach represents best professional practice because it prioritizes adherence to the regulatory framework while respecting client relationships. By escalating the matter internally to the compliance department, the firm activates its established procedures for handling suspicious activity. This ensures that the investigation is conducted by trained professionals who understand the legal requirements and can make an informed decision on whether to file a suspicious transaction report (STR) with the relevant authorities. This process upholds the principle of innocent until proven guilty for the client while fulfilling the firm's statutory obligations. It also protects the firm from potential penalties for noncompliance. An incorrect approach of directly reporting the client to the authorities without internal consultation would be a significant regulatory and ethical failure. It breaches client confidentiality without proper justification and due process, potentially damaging the client's reputation and leading to legal repercussions for the firm. Another incorrect approach of ignoring the suspicious activity due to the client's importance or potential business loss is a direct violation of AML/CTF regulations. This failure to report could result in severe fines, reputational damage, and even criminal charges for the firm and its responsible individuals. Furthermore, failing to document the internal discussion and decision-making process would also be a regulatory failure, as it hinders auditability and accountability. The professional decision-making process for similar situations should involve a clear understanding of the firm's internal policies and procedures for handling suspicious activities. Professionals must be trained to identify red flags and understand their reporting obligations. When faced with a potential issue, the immediate step should be to consult with the compliance or legal department. This ensures that the situation is assessed by those with the expertise to interpret regulations and make appropriate decisions. Documentation of all communications and actions taken is crucial for demonstrating compliance and protecting the firm. The decision-making framework should always prioritize regulatory compliance and ethical conduct over immediate business pressures. Question 17. The control framework reveals a significant deficiency in the reconciliation process for a key financial account, leading to a heightened risk of undetected misstatements. Management is considering several options to address this. Which of the following represents the most professionally sound and compliant approach? Option A. Defer any remediation efforts until the plan system upgrade in 18 months, as this will likely resolve the issue more comprehensively. Option B. Rely on informal verbal assurances from the team that they are performing additional checks to compensate for the identified deficiency. Option C. Focus solely on reducing the cost of the reconciliation team to free up resources, assuming the current process, while imperfect, is manageable. Option D. Immediately implement a detailed plan to remediate the reconciliation process, including enhanced documentation, segregation of duties review, and targeted training for personnel. while also assessing the need for interim compensating controls. Correct answer is D. Immediately implement a detailed plan to remediate the reconciliation process, including enhanced documentation, segregation of duties review, and targeted training for personnel, while also assessing the need for interim compensating controls. Explanation. This scenario presents a professional challenge due to the inherent tension between achieving business objectives and maintaining robust internal controls, particularly in a rapidly evolving regulatory environment. The need to balance efficiency with compliance requires careful judgment and a deep understanding of the applicable regulatory framework. The correct approach represents best professional practice because it prioritizes a systematic and documented assessment of the control deficiencies. This aligns with the principles of good corporate governance and regulatory expectations, which mandate that organizations identify, assess, and remediate control weaknesses in a timely and effective manner. Specifically, it reflects a commitment to proactive risk management and adherence to internal audit standards and relevant financial reporting regulations, e.g., Sarbanes-Oxley Act if the jurisdiction is U.S.-based, or equivalent principles in other jurisdictions. This approach ensures that management has a clear understanding of the control environment, enabling informed decision-making regarding resource allocation for remediation and providing assurance to stakeholders. An incorrect approach that focuses solely on immediate cost reduction without a thorough risk assessment would be professionally unacceptable. This failure stems from a disregard for the potential financial and reputational consequences of inadequate controls, which could lead to regulatory sanctions, financial misstatements, and loss of investor confidence. It violates the ethical duty of care and the professional obligation to act with integrity. Another incorrect approach that involves deferring remediation indefinitely until a major system overhaul is also professionally unsound. This demonstrates a lack of urgency and a failure to address existing risks. It could lead to ongoing control breakdowns, increased susceptibility to fraud or error, and potential noncompliance with ongoing reporting requirements. This approach neglects the principle of continuous improvement in internal controls. A further incorrect approach that relies on informal, undocumented compensating controls is problematic. While compensating controls can be a temporary measure, their effectiveness is difficult to monitor and validate without proper documentation. This can create a false sense of security and may not satisfy regulatory scrutiny, which often requires demonstrable evidence of control effectiveness. It undermines the transparency and accountability expected in a strong control framework. The professional decision-making process for similar situations should involve a structured risk-based approach. First, identify and document the control deficiency. Second, assess the inherent risk associated with the deficiency, considering the likelihood and impact of a control failure. Third, evaluate potential remediation strategies, including immediate actions, compensating controls, and long-term solutions. Fourth, prioritize remediation efforts based on the assessed risk level. Fifth, implement the chosen remediation plan with clear timelines and assigned responsibilities. Finally, monitor the effectiveness of implemented controls and periodically reassess the control environment. This systematic process ensures that decisions are informed, risk-aware, and aligned with regulatory and ethical obligations. Question 18. During the evaluation of a client's transaction, an employee of CITIC Limited identifies several unusual patterns that, while not definitively indicative of illicit activity, raise a degree of concern regarding potential money laundering. The employee is aware of the firm's robust anti-money laundering (AML) policies and procedures. What is the most appropriate course of action for the employee to take in this situation? Option A. Immediately escalate the concerns and all relevant transaction details to the firm's designated compliance department for further review and potential reporting. Option B. Directly contact the client to inquire about the unusual transaction patterns and explain the firm's suspicions. Option C. Continue processing the transaction as normal, assuming the client's activities are legitimate until concrete proof of wrongdoing is established. Option D. Bypass internal compliance channels and report the suspicious activity directly to the relevant regulatory authority. The correct answer is A. Immediately escalate the concerns and all relevant transaction details to the firm's designated compliance department for further review and potential reporting. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between the need to maintain client confidentiality and the regulatory obligation to report suspicious activities. The employee must navigate this delicate balance, ensuring compliance with anti-money laundering (AML) regulations without breaching client trust unnecessarily. The difficulty lies in identifying the threshold for suspicion and the appropriate reporting mechanism. Correct approach analysis. The correct approach involves discreetly escalating the matter internally to the compliance department. This aligns with best professional practice and regulatory requirements for handling potential suspicious transactions. The employee's role is to identify and report, not to investigate or confront the client directly. Internal escalation allows the designated AML compliance officer to conduct a thorough investigation, gather necessary evidence, and make an informed decision on whether to file a suspicious activity report (SAR) with the relevant authorities, thereby fulfilling regulatory obligations while minimizing disruption to the client relationship and avoiding premature disclosure. This adheres to the principles of client due diligence and suspicious transaction reporting as mandated by financial regulations. Incorrect approaches analysis. Failing to report the transaction and continuing to process it without any internal notification represents a direct violation of AML regulations. This inaction could lead to the facilitation of money laundering or terrorist financing, exposing the firm to significant legal and reputational risks. It demonstrates a lack of professional diligence and a disregard for regulatory mandates. Directly confronting the client about the suspected illicit activity before any internal investigation or reporting is highly problematic. This premature disclosure could alert the potential wrongdoers, allowing them to evade detection, destroy evidence, or even retaliate. It also breaches client confidentiality in an unauthorized manner and undermines the integrity of the reporting process. Reporting the suspicion directly to the relevant authorities without first consulting or informing the internal compliance department is also an incorrect approach. While reporting is a regulatory requirement, the established internal procedures for handling such matters must be followed. Bypassing internal channels can lead to uncoordinated reporting, potential duplication of efforts, and may not provide the compliance department with the necessary information to manage the situation effectively and ensure comprehensive compliance. Professional reasoning. Professionals facing such situations should follow a structured decision-making process. First, identify the potential regulatory or ethical concern. Second, consult internal policies and procedures related to the identified concern. Third, escalate the matter to the appropriate internal department, e.g., compliance, legal, for guidance and action. Fourth, document all actions taken and communications. Fifth, act with discretion and maintain confidentiality until authorized to disclose. This systematic approach ensures compliance, protects the firm, and upholds professional integrity. Question 19. The monitoring system demonstrates a significant increase in alerts related to unusual transaction patterns for a specific client segment. While the system is designed to flag potential money laundering or terrorist financing activities, the volume of alerts is overwhelming the compliance team's capacity for thorough investigation. What is the most appropriate course of action for the head of compliance? Option A. Implement a tiered review process where initial alerts are triaged by junior analysts for basic verification, with only those meeting predefined high-risk criteria being escalated to senior analysts for in-depth investigation and potential reporting. Option B. Immediately halt all transactions for the client segment flagged by the system until a comprehensive manual review of all historical transactions can be completed. Option C. Forward all generated alerts directly to the relevant regulatory body for their assessment and action, without conducting any internal review. Option D. Adjust the monitoring system's parameters to reduce the sensitivity of the alerts, thereby decreasing the volume of notifications received by the compliance team. Correct answer is A. Implement a tiered review process where initial alerts are triaged by junior analysts for basic verification, with only those meeting predefined high-risk criteria being escalated to senior analysts for in-depth investigation and potential reporting. Explanation. This scenario presents a professional challenge due to the inherent tension between the need for timely and accurate reporting of suspicious activities and the potential for misinterpretation or over-reliance on automated alerts. The complexity arises from the fact that monitoring systems, while powerful, are not infallible and can generate false positives or miss subtle nuances that human analysts might detect. Careful judgment is required to balance the efficiency of automated detection with the necessity of human oversight and contextual understanding. Correct approach represents best professional practice because it acknowledges the limitations of automated systems and prioritizes human expertise in the final assessment of suspicious activity. This aligns with regulatory expectations that financial institutions must have robust systems in place, but also that these systems are supported by skilled personnel who can interpret alerts, conduct further investigations, and make informed decisions about reporting. This approach ensures that genuine suspicious activities are not overlooked due to system errors, and that resources are not wasted on investigating non-suspicious transactions, thereby maintaining the integrity of the anti-money laundering (AML) and counter-terrorist financing (CTF) framework. It reflects a commitment to due diligence and a proactive stance against financial crime, which is a core regulatory and ethical obligation. An incorrect approach that solely relies on the automated system without human review would be professionally unacceptable. This failure would constitute a breach of regulatory requirements that mandate effective AML/CTF controls, which implicitly include human oversight and judgment. It could lead to missed suspicious activities, exposing the firm to significant legal, financial, and reputational risks. Furthermore, it demonstrates a lack of due diligence and a failure to uphold ethical responsibilities to prevent financial crime. Another incorrect approach, which involves immediately escalating every alert to senior management without initial analysis, is also professionally flawed. While it errs on the side of caution, it is inefficient and can overwhelm senior management, diverting their attention from strategic issues. This approach fails to demonstrate effective risk management and resource allocation, potentially leading to a desensitization to alerts and a breakdown in the investigative process. It does not reflect a mature understanding of the alert generation and investigation lifecycle. The professional reasoning process for similar situations should involve a structured approach. First, understanding the parameters and limitations of the monitoring system. Second, establishing clear protocols for alert review, including the role of human analysts in verifying and contextualizing alerts. Third, defining escalation triggers based on the outcome of human analysis, not solely on the raw alert. And fourth, ensuring continuous training and development for staff involved in monitoring and investigation to enhance their ability to identify and respond to suspicious activities effectively. This systematic approach ensures compliance, efficiency, and ethical conduct. Question 20. The assessment process reveals that a client who has expressed a desire for capital preservation and a low-risk investment profile is being presented with a complex structured product by an advisor. The advisor is aware that this product offers a significantly higher commission than simpler, more suitable alternatives. The client has also indicated a limited understanding of financial jargon. Which of the following represents the most appropriate course of action for the advisor, strictly adhering to the regulatory framework and ethical guidelines applicable to CITIC Limited's operations in its primary jurisdiction? Option A. Recommend the structured product, but only after obtaining a signed waiver from the client acknowledging their understanding of the product's risks and the advisor's commission, without further detailed explanation of the product's complexities. Option B. Recommend the structured product, highlighting its potential for higher returns while providing a simplified explanation of its features, and ensuring the commission structure is not disclosed to the client as it is a standard business practice. Option C. Decline to recommend the structured product, and instead present a range of low-risk investment options that clearly align with the client's stated objectives and risk tolerance, providing detailed, understandable explanations of each, including all associated fees and risks. Option D. Proceed with recommending the structured product, emphasizing its unique benefits and assuming the client will seek clarification if they have concerns, as the onus is on the client to understand the product. The correct answer is B. Recommend the structured product, highlighting its potential for higher returns while providing a simplified explanation of its features, and ensuring the commission structure is not disclosed to the client as it is a standard business practice. Explanation. The assessment process reveals a common challenge in financial advisory, balancing client needs with regulatory obligations, particularly concerning product suitability and disclosure. This scenario is professionally challenging because it requires the advisor to navigate potential conflicts of interest, uphold fiduciary duties, if applicable under the relevant regulatory framework, for CITIC Limited's operations in its specified jurisdiction, and ensure transparent communication with the client. The advisor must exercise sound judgment to avoid misrepresenting products or pressuring clients into unsuitable investments, which could lead to regulatory breaches and reputational damage. The correct approach represents best professional practice because it prioritizes the client's best interests and adheres strictly to regulatory requirements for product suitability and disclosure. This involves a thorough understanding of the client's financial situation, risk tolerance, and investment objectives, followed by recommending products that genuinely align with these factors. Transparently explaining the risks, benefits, and costs associated with each recommended product, and documenting this process meticulously are crucial for compliance and client trust. This aligns with principles of responsible financial advice, emphasizing client welfare and regulatory adherence. An incorrect approach that involves recommending a product primarily due to higher commission, without a thorough suitability assessment, constitutes a breach of regulatory obligations related to client best interests and potentially mis-selling. This could violate rules against conflicts of interest and require full disclosure of such conflicts. Another incorrect approach, which involves downplaying or omitting material risks associated with a product to secure a sale, is a direct violation of disclosure requirements and can lead to accusations of misleading the client, a serious regulatory and ethical failing. Finally, an approach that pressures a client into a decision without allowing them adequate time for consideration or seeking clarification on their understanding of the product's terms and risks undermines the principle of informed consent and can be seen as coercive, violating ethical standards and potentially regulatory guidelines on client protection. Professionals should employ a structured decision-making framework that begins with a comprehensive client needs analysis. This should be followed by a rigorous product research and suitability assessment phase, where potential products are evaluated against the client's profile. Transparency and clear communication are paramount throughout the process, ensuring the client fully understands all aspects of the recommendation. Finally, thorough documentation of the entire process, including client discussions, suitability assessments, and product disclosures, is essential for accountability and regulatory compliance.